This investigation is based on publicly available reports, court documents, regulatory findings, and reputable journalism. Imagine borrowing tens of billions of dollars without actually owning tens of billions. Now imagine losing so much money that some of the world's largest banks begin losing billions alongside you. This wasn't a global recession. It wasn't another financial crisis. It wasn't even a hedge fund. It was a family office, a private investment firm that most people had never heard of. Yet, in just a few days, Archegos Capital triggered one of the largest and fastest wealth destructions in modern financial history. The question isn't how Bill Hwang lost billions. The question is how so many sophisticated institutions allowed one investor to become so dangerously powerful in the first place. Before Archegos became a global headline, Bill Hwang was already well known inside Wall Street. He worked under legendary investor Julian Robertson at Tiger Management, one of the most influential hedge funds ever created. Former Tiger analysts became known as the Tiger Cubs, managing billions of dollars around the world. Bill Hwang was one of them. He built a reputation as an aggressive investor with enormous conviction. He believed that concentrated positions produced extraordinary returns. Sometimes they did. But concentration has a hidden cost. When everything goes right, it creates spectacular success. When something goes wrong, it leaves almost no room to recover. That philosophy would eventually define Archegos. Unlike a traditional hedge fund, Archegos operated as a family office. That distinction mattered. Family offices generally face fewer disclosure requirements because they manage private wealth instead of outside investors' money. To the public, Archegos remained almost invisible. But behind the scenes, some of the world's largest investment banks were competing for its business. Why? Because Archegos traded enormous volumes. Every transaction generated fees. Every new position meant more revenue for the banks involved. Competition created a dangerous incentive. Each bank understood only part of Archegos' exposure. No single institution could see the complete picture. And when nobody sees the entire puzzle, everyone tends to underestimate the risk. The real story of Archegos wasn't about picking the right stocks. It was about borrowing enormous amounts of money. Through a financial instrument called a total return swap, Archegos could gain exposure to billions of dollars worth of shares without officially owning many of them. Think of it like controlling a luxury apartment without buying the building. You don't appear as the owner, but you still benefit if its value rises. And if the price falls, you absorb the losses. Banks loved these transactions. They generated steady fees. Archegos loved them even more. They allowed Bill Hwang to build positions that were many times larger than his own capital. Leverage is often described as a financial tool, but that's only half the story. Leverage is really an amplifier. When you're right, it makes you look like a genius. When you're wrong, it turns a mistake into a catastrophe. And here's where things became even more dangerous. Archegos didn't borrow from just one bank. It borrowed from several. Each institution believed it understood the risk, but none of them knew the full size of Archegos' positions across the entire financial system. Risk wasn't being reduced. It was simply being hidden. As the positions grew larger, something unusual began to happen. Archegos wasn't simply investing in companies. It was becoming one of the biggest buyers of certain stocks. Every new purchase pushed prices higher. Higher prices increased the value of Archegos' portfolio. A larger portfolio allowed the firm to borrow even more money, which allowed it to buy even more shares. It became a self-reinforcing cycle. The market interpreted rising prices as proof that investors were becoming more optimistic. But in reality, one highly leveraged investor was responsible for a significant portion of the demand. The illusion became stronger with every dollar borrowed. This is one of the most dangerous feedback loops in financial markets. Success attracts leverage. Leverage pushes prices higher. Higher prices create even greater confidence. Eventually, the price itself becomes the evidence. Not the business, not the fundamentals, just the price. Every financial illusion eventually meets reality. For Archegos, that moment arrived in March 2021. Several of its largest holdings began falling. One decline triggered another. As prices dropped, banks demanded additional collateral. Those requests are known as margin calls. Normally, investors meet them by depositing more cash. But Archegos didn't have enough. The bank suddenly faced the same decision. Wait, or sell. Some moved first. Others hesitated. That hesitation would prove incredibly expensive. Within hours, billions of dollars worth of shares flooded the market. The forced selling pushed prices even lower, which triggered even more selling. It wasn't panic. It was mathematics. The speed of the collapse shocked Wall Street. Goldman Sachs moved quickly. Morgan Stanley acted rapidly. Other banks reacted more slowly. Credit Suisse became one of the biggest casualties. The losses reached billions of dollars. Senior executives resigned. Risk management practices came under intense scrutiny. What made the collapse remarkable wasn't simply the amount of money lost. It was the realization that sophisticated institutions had underestimated the same client at the same time. Everyone believed someone else had already measured the risk. No one had. Archegos wasn't large enough to threaten the global financial system, but it was large enough to expose how fragmented modern finance had become. Sometimes, the greatest danger isn't what institutions know. It's what they assume other institutions already know. Archegos teaches a lesson that extends far beyond one investor. Leverage doesn't create wealth. It borrows confidence from the future. As long as prices continue rising, everything appears safe. Banks collect fees. Investors celebrate returns. Markets reward success. But leverage changes something fundamental. It compresses time. Years of gains can disappear in days. Months of confidence can vanish in hours. And once forced selling begins, there is no negotiation with mathematics. That's why financial history keeps repeating the same pattern. Complexity hides risk. Success hides complexity. Confidence hides both, until reality removes every illusion at once. Archegos didn't invent leverage. It simply revealed what happens when leverage becomes invisible. Markets often celebrate extraordinary success, but extraordinary success always deserves extraordinary scrutiny, because the most dangerous risks are rarely the ones everyone can see. They're the ones hidden behind confidence, complexity, and the assumption that someone else has already checked the numbers. History remembers the collapse. We investigate the pattern. Every financial crime leaves a trail. Follow it.